Hi, this is Michael Neuenschwander with Outlook Wealth Advisors, a CPA as well as certified financial planner. So we're going to split today's topic into two videos. We'll cover 4 of them today, and the next 4 in the next video. So if you want to make sure that you're aware and join us in that next video, be sure to hit the subscribe down below. So as we get into it, we want to make sure we're covering things that not just give us some tax savings today, but ultimately give us some long-term tax savings as well. So the first tip we're going to cover, potentially delaying Social Security for a tax benefit. Now, in a previous video, we touched on a little bit about why you may want to start Social Security early, or maybe some myths around that. But the way Social Security is taxed is a function of the rest of your income. So what I mean by that, worst case, Social Security is taxed at 85%. Now, most people don't necessarily think of Social Security as a way to save on taxes, but let's compare that, what I just said, to an IRA distribution. If money comes out of your IRA, 100% of it is taxable. So worst case, Social Security is always going to be 15% more tax advantaged than an IRA distribution. Now, depending on the amount of income you need, the sources of the rest of your income, amount in IRA accounts, Social Security can also be completely tax-free. So it's a sliding scale between 0 taxable up to 85% taxable. But by delaying on Social Security, one thing from a tax benefit point of view is if you have a larger check that now covers more of the withdrawals you need in retirement, and that larger check is now tax advantaged, that potentially saves you a lot of taxes in the long run. Now, I will throw out sort of the caveat, unfortunately, we have to say, that works so long as required distributions aren't forcing you into a higher tax bracket. So as we touched on before, one of the reasons for potentially starting Social Security early versus later has to do with the size of your IRA account and what those RMDs may be. So on top of the Social Security potentially just being more tax efficient, the amount of Social Security that's actually taxed is determined by everything else, as I mentioned. So whether you got rental income, dividend income. So by strategically planning based on your personal, income scenario, you may be able to save a significant amount in taxes while still having the income you want, simply by determining how much of it should be coming from Social Security versus how much of it comes from IRAs or other accounts. And the main determining factor on what you get from Social Security is the time in which you take it. So to give you a quick, simple example of this, suppose if somebody was starting Social Security early and their Social Security benefit was going to be $30,000, but keep it simple, they needed $50,000 to live on. So at $30,000, they still have to make up that difference from their retirement account. And so when you plug that in and say, well, $30,000 for a single person with Social Security plus $20,000 of IRA distribution, they're going to owe taxes in that $4,000 or $5,000 range. However, suppose this person then waited till 70. So instead of getting $30,000 a year, now they're getting $40,000 a year. Well, in that case, if they still need 50 as the total number, by only taking 10,000 out of the retirement accounts, the majority of their money coming from Social Security, now their tax bill drops all the way down to about $1,500. And so that's just a quick, easy example how if you're able to have the Social Security fulfill a majority of your retirement income needs, that may be an example where delaying on Social Security and getting the higher check actually saves you tax money as well. As I mentioned, that's not a strategy that fits everybody, so it's one of those where we look at your personal facts and circumstances to see, does that make the most sense for you? But certainly Social Security can be one of those tax tools for saving money in retirement. So the second tip we want to use when it comes to saving money and taxes in retirement is really about, do you have the right assets in the right account? So rather than just asset allocation or diversification, it's really, call it an asset strategy idea. So let's take this as a simple example. Suppose you have an IRA and non-retirement account, but you also have what I would call a traditional asset allocation, meaning if you're retired, so you've got 60-40, 60% stock, 40% bonds. Now, many people may have that same allocation across multiple accounts and say IRA account 60-40 and their non-IRA account is also 60-40. However, by doing so, you're not taking advantage of the tax rules built around certain types of investments. What I mean by that is the stock generally would produce dividends or produce capital gains. But stock held in an IRA, you're not going to get either of those. As it comes out of the IRA, it's taxed as ordinary income. So if we used an example for somebody who was in a 22% tax bracket, if it comes out of the IRA, it's taxed as 22%. However, if they were able to get the benefit of qualified dividends and long-term capital gains, that would be taxed at 15%, not 22%. So you can either look at it as it's an immediate 7% tax savings, or said another way, it's a 7% additional return on your money. So how would you do it? Well, if you've got other things, let's take bonds. So if your typical portfolio is 60-40, so that's 60% that's in stock, perhaps you should own that in your non-retirement account. Now you'll have the ability to actually recognize those long-term capital gains and those qualified dividends. If on the other hand, well, what about the 40% that's in bonds? Now, again, this isn't a discussion today on whether 60-40 is a good allocation or stocks or bonds, but if you had it in bonds, and bonds generate interest income. Interest income never gets a tax break. It's always taxed, in this case, at 22%. So wouldn't it make more sense to own those bonds inside the IRA account? Because they were going to get taxed as ordinary income, whether they were outside the retirement account or it was coming as a distribution. So that's one big piece many people often overlook, is simply the fact, do you have the right assets in the right account? And by doing so, you can save money every single year. And as we said in the beginning, every little bit that you save either makes your money last longer, can be looked at as a better overall return for you, or less going to the IRS means more money that stays with you and your family. And that's really the goal of the tax strategy, isn't it? So as we summarize tip number 2, having the right investments in the right type of account, you'll put it simply in that 60-40 allocation would mean 60% goes into the non-retirement or the brokerage account. The 40% of bonds, the more interest-oriented investments, goes in the IRA. Now we can take this one step farther. If you have a Roth IRA, that changes the strategy slightly and saying, well, if the Roth IRA is all about tax-free growth, why would you have 40% of the IRA in bonds? So taking it a step farther, it says the growth money should be in the Roth IRA because we want long-term growth and we want it to be tax-free. So simply put, tax tip number 2 is making sure you have the right assets in the right account to 1, lower taxes, but 2, put yourself in a position where the best growing things you have ideally are either taxed very little or perhaps tax-free as well. So now let's head into our third tax tip, taking advantage of this closing tax opportunity. Right now, we're operating under the 2018 Tax Cut and Jobs Act. Built into that tax act, though, was an expiration date when it came to all the personal tax exemptions, lower tax rates, bigger standard deduction. As the law stands right now, that expiration date is December 31st of 2025. So what does that mean for most of us? In general, all the tax brackets shifted down 2 to 4%, and the standard deduction went up by about $10,000. So we can enjoy that for the next couple of years with the big asterisk next to it that says certainly Congress can get together and pass a law and change that at any time. Potentially they could extend it, but to be fair, in the history of the IRS, a law that has a sunset provision has never been extended exactly the way it was written. So as we look at that, we have potentially a closing window of lower tax brackets. And to give a little perspective to what 2 to 4% means, that may be a little misleading. So today, a moderate or low tax bracket is 12%. Next bracket up is 22%. When the tax law reverts back, that 12% bracket goes up to 15%. So okay, well, it's 3%, no big deal, right? Well, let's check our math real quick, but a 3% increase on a 12% bracket is actually a 25% increase in the tax rate. Not quite as bad on the 22%. 22% goes back up to 25%. So again, around a 13-14% tax increase. and at the same time, the standard deduction drops by about $10,000. So as we look at this tax opportunity over the next couple of years, that's one of the big things almost everybody should be paying attention to. What does your tax picture look like today when it comes to earned income if you're still working, or when it comes to distributions if you're retired? If you're retired, what does that look like when required distributions kick in if you're not there yet? Do they kick in around the same time taxes go up? So maybe you should be looking at Roth conversions or tax strategies today to head some of that off. And if you're still working, I said, what does your potential income look like? Are you likely to earn more in the future than you earn today? If you're fortunate enough where you have 401k with a match, or you have a Roth 401k, those are some of the strategies you may be considering when we're talking about this closing tax window of opportunity that we have. Now let's move on to our last tip for today's video. So tip number 4, so earning a health tax credit. Now this, for some people, can be a huge deal. So if you're under age 65 and retired and need to get health insurance, for the most part, you only have a few choices. You can choose from the Affordable Care Act. Says you go to the exchange, you choose a plan based on that, but what you pay for that plan is driven by what does your income look like. Typically, those plans are subsidized. You don't necessarily directly see it as a subsidy, but that subsidy comes in the form of your taxes. So you may look and say, well, that plan is going to cost us $2,000 a month. However, if we keep our income below certain thresholds, we may really only pay $500 or $600 for that plan instead. So prior to 65, you're generally needing to make decisions about your health insurance. So if you're looking for insurance prior to 65, you can use what's called a shared health plan. Those generally originated out of churches where they didn't want to support, certain things that the government had built into health insurance. If you're in good health, you can generally get one of those, and it's less expensive than traditional insurance. However, for most people, you may find you need to go to the exchange, the Affordable Care Act. And the way those policies work is they're based on your income determines how much you pay. And in general, you can have a choice. Do you want a gold, a silver, a bronze? So the level of coverage, as well as also depends on what state or what zip code you're in. But the way those plans work, you don't get a direct subsidy. However, it's run through your tax return. So even though the plan may say it's going to cost you $2,000 a month, based on the rest of your income, it may only cost you $500, $600, $700 a month. Now, what happens is if you overshoot that income, if you told them, I think we're going to make $70,000 a year, then your premium is here. When you do your taxes, if in fact you made $90,000 instead, well, you're going to owe taxes, not because you owe income tax, but because they're basically recouping the subsidy that they gave you ahead of time. So as we look at that kind of strategy and say, how do we work that to your advantage? Well, go back to those multiple accounts. If you're arriving at retirement and you have a Roth IRA, a traditional 401k IRA, and you have a brokerage account, controlling what your income looks like, even if it's for only a few years, can have a significant impact on what you pay for medical expense. I'll give you a real-world example that we're dealing with for a client on a regular basis right now. They're both retired, both under 65. If we looked and said their insurance premiums, if we just had to pay for it outright, were going to be in the neighborhood of $2,100 per month. In the big picture, we would love to be doing Roth conversions, one of the other strategies we've touched on before. But to do Roth conversions, we would recognize much higher income. So we've made the conscious decision in their plan to say for the next couple of years, we are foregoing large Roth conversions. We're foregoing taking much distribution from the IRA. Instead, they're using that after-tax money. While you can live off of after-tax money, the taxation on it is very little. In doing so, we're actually saving not a couple $1,000 here and there, but the difference between having to pay $24,000 a year for health insurance versus paying about $6,000 a year. And as much as I love Roth conversions, it's hard to pass up an immediate savings of almost, almost 16,000 bucks. So taking advantage of the Affordable Care Act, if you're in a position to where you have to get health insurance under age 65, it's critical that you know how the rules work, and it's critical that you have a plan for how to distribute the money so you have the money you need to live off of, but ideally you're keeping the recognition of income, the taxable income, low, so you're getting as much of a benefit as you can to help pay for that expensive health insurance. So in today's video, we covered really 4 tips on how to save money on taxes in retirement and put yourself in a better position. Join us next time or subscribe so that you'll catch our next video when we cover the next 4 tax tips on how to make sure you keep your money working for you in retirement and you're trying to avoid paying any unnecessary tax that you may otherwise don't need to pay. Hopefully this has been beneficial for you today. We look forward to joining you next time. Thank you.